In this video, we're going to look at ONEOK. This is an oil and gas midstream company. And what I do in my videos is I try to figure out the actual stock price using prior financial information, and then look at the financial ratios of the company and compare them with similar companies in the industry. So let's get started with the model. The company has a market cap of $11.4 billion. That's the value of the company according to the stock market. And now we need the stock price, and that's $27.58. Next, we need the free cash flows, and this is the cash that's remaining after running your business. And you can see in 2019 they have negative free cash flow, and I can show you why. Because the way free cash flow is calculated, it's cash flow from operations minus CapEx, capital expenditures. To calculate the 2019 free cash flow, it's the cash flow from operating activities, the $1.9 billion, minus the investments in property, plant, and equipment, the $3.8 billion. So they have a negative amount of cash that year. They spent more money than they generated. Now, this is not a terrible thing, because when you invest in property, plant, and equipment, those are assets which can be used over a long period of time. As long as those assets bring in more money than they cost you. And a lot of companies in the first few years of operations, they have negative free cash flow because they're investing in their business. So the idea is it's going to eventually pay off. So this could negatively affect the model, having this negative $1.9 billion of free cash flow. Let's get their net income. This is the profit and loss according to the income statement. Now I'm pulling the revenue, which are the sales for the company. And I'll put that into the model. So these are the numbers I just input, and it also shows us a net profit margin, which is net income over revenue. So you can see in 2019, they have the highest net income margin of the 4 years. So their revenue did decrease from 2018 to 2019, but you could see their net income increased. So they're more efficient at generating income. So in 2019, they probably did some cost cutting. Let's look at the capital structure of the company to figure out the discount rate we need to apply to the future cash flows. So they have an interest expense of $492 million. That's interest they pay on the debt. And we'll go to the balance sheet to see how much debt they have. So current debt of $227 million, that's debt due within 1 year. And then long-term debt of $12 billion, that's debt due after 1 year. So they pay 3.9% interest on the debt. Since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. The income before tax is $1.7 billion. And the income tax is $372 million. So the cost of debt is 3%. Let's get the cost of equity. We need the beta for that. And the beta is how much the stock moves relative to the market. So they have a beta of 2.12. So the stock moves twice as much as the market. So if the market went up 1% today, for example, this stock should go up a little more than 2%. So this is a high beta, so it is more volatile, the stock, and tends to be more risky. So we need to look at the financial ratios at the end of the video. So let's get their current assets. That's $1.5 billion, and those are cash, accounts receivables, and inventory, assets that can be liquidated into cash within 1 year. Now let's get their current liabilities. These are debts and payables, which are due within 1 year, and that's $2 billion. And their equity is $6.2 billion. That's assets minus liabilities. And their EBIT, earnings before interest and taxes. On the income statement, that's called operating income. That's how much money the company makes on its operational, everyday business, but before it pays interest expense and income taxes. The cost of debt is 3%, and they have 67% debt in the capital structure. The cost of equity is 19%, and we use the capital asset pricing model to figure that out. And the weight of equity is 33%. So to get the WACC, it's a blend of the cost of debt and the cost of equity, and that's 8.13%. and that's what we're going to discount the future cash flows. So we discounted 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers based on the weighted average cost of capital. And we get a value of the company of $6 billion. We divide that by 413 million shares, and we get an intrinsic stock price of $15. It's trading at $28, so it's trading at a 90% premium. So it's a sell according to the model. Let's see what Simply Wall Street calculates. And they're calculating the stock price at $28, which is pretty much what they're trading at. So it's possible they didn't put much relevance in the negative $1.9 billion in 2019, and I think that dragged down my intrinsic value. Let's look at the historical stock price. So it looks like it was trading way higher for a while, and then it's dropped like everything else in March, and it's come back up a little bit, and it's sitting around $30. Let's look at the financial ratios of the company. They have a price to earnings ratio of 9. That's a good ratio. That's price to stock over earnings per share. Price to sales is also good at 1.1. That's price to stock over sales per share. A good price to book of 1.8. That's price of stock over book value per share. They don't have a good current ratio. It's 0.7. That's current assets over current liabilities. So they can't cover their current liabilities with their current assets. So that could be a problem. They may need to take on more debt, or it could be a timing issue where next quarter this might be fixed, this ratio. ROE is pretty good at 21%. That's net income over equity. They could cover their interest payments 4 times, so that's okay. And they're a little leverage at 67% debt. So the other company I can compare them to is MPLX. They're in the same industry as ONEOK. And ONEOK wins in almost every category. As you can see, they're in orange. That means they have a better ratio if it's in orange. The only ratio MPLX is better is market cap. And the reason MPLX has an NA for price to book and ROE is because they have 100% debt. So they have no equity in their capital structure. Since ROE is income over equity and equity is 0 for this company, you can't have 0 in the denominator of a fraction. I hope you enjoyed the video. Let me know what you think. Thanks for watching.